Hey, good afternoon, guys. So today we are going to learn the concept of payback period, especially discounted payback. So discounted payback means the amount of time which is required to recover the initial amount invested in that project. For example, if I have invested 1 crore in the project and if I calculate the net present value of the project, or I calculate the discounted cash inflows from that project, and I find out that in the fourth year of operation I recover uh, the 1 crore initially invested. That means cumulatively my cash inflows which are discounted equals to the initial investment. All right, so for explaining that, let us take one example. So here, as you can see, a limited company is considering investing a project which requires a capital outlay of 2 lakh. Forecast for annual income after depreciation but before tax is as follows. So that means they have provided the depreciation but tax is not yet taken. So we will have to do what to find out the cash inflows. We will have to uh, reduce the tax and add back the depreciation amount. All right. So they have asked us to calculate a lot of things, but for now, what we will do, we will calculate just discounted payback. All right. So cash inflows are calculated here. So as you can see, present value interest factors are mentioned here at the rate of what percent. They have given us the discounting factor of 10%. So at the rate of 10%, present value interest factors are mentioned here, and cash inflows are calculated as here. So we have reduced the taxes and added back the depreciation. So cash inflows are like this. All right. So initial investment is 2 lakh and cash inflows are like this. So if you I have put a column called as cumulative present value of cash inflows. So at the end of first year, cumulative cash inflow is 81,000. At the end of second year, it is 81,000 plus cash inflow for the second year, which is discounted, that is 74,380. All right. So that becomes 1.56 lakh. And at the end of third year, the total value of cumulative cash inflows, discounted cumulative cash inflows, becomes 2,16,000, which is more than our initial cash outflow. All right. So what does this mean? This means that our discounted payback period lies between second year and third year. All right. So how will I calculate the discounted payback from here? So the formula is discounted payback is equal to, we know that it is after 2 years, because at the end of 2 years our cumulative cash inflow is 1.56 lakh and we have to reach till 2 lakhs. Okay, so 1.56 lakh recovered at the end of 2 years. So 2 years plus initial investment minus cumulative value till last year, cumulative cash inflow value till last year, divided by total cash flow in the year of break even. So break even means in the year in which we have our discounted payback. So putting values in this formula, our discounted payback period is equal to 2 years plus initial investment is 2 lakhs. So 2 lakhs minus cumulative cash inflows till last year, that is second year, which is 1.56 lakh. Right, 2 lakh minus 1.56 lakh, bracket complete, divided by our cash inflow, discounted cash inflow in the year of break even, that is third year, which is 60,105. All right. So when we calculate this, it will be like 2 lakh minus 156 198, 180 156 198 divided by 43,802 divided by 60,105. So that is 0.72. So that means our discounted payback period in this case is 2 years and 0.72, 2.72 years. So that is roughly about 2 years and 9 months, right? So this was discounted payback period. Also, to calculate accounting payback, we just have to ignore the present value. So in this case, what we will do to calculate accounting payback, we will just take our cash inflows without discounting, that is these are the without discounting cash inflows. So as you can see, cumulative cash inflow figures are here: 90,000 at the end of year 1, 1,80,000 at the end of year 2, and 2,60,000 at the end of year 3. So again our payback period, accounting payback period, lies between year 2 and year 3. So calculating the same, 2 years plus initial investment minus cumulative value till last year divided by total cash inflow in the year of break even. So 2 lakh, 2 years plus 2 lakh minus 1 lakh 80,000, that is our cash inflow without discounting till last year, divided by cash inflow in the current year, that is without discounting 80,000. So 2 years plus 2 lakh minus 1 lakh 80,000, that is 20,000, divided by 80,000, so that will be 0.25, right? So our accounting payback is 2.25 years, that is 2 years 3 months, right? Hope you understood both the concepts, discounting payback and accounting payback. So how to make the decision on the basis of this tool in investment decisions? So if our discounting payback is lesser than the useful life of the project, if our discounted payback is lesser than useful life of the project, then we can go ahead and select that project. For example, in this case our discounted payback is 2 years 9 months and our project life is 5 years, then we can accept this project, because that means when we recover our amount, initial investment amount, after 3 years or 2.72 years, then remaining time, which is the time which is remaining in that project, we can earn the profit on that project. All right, thank you.